A super CFD trader. Again, tonight's class is sponsored by investing.com and UBCFX. So in tonight's class, I'm going to use the term security when referring to all tradable financial instruments. Now, this would include stocks, bonds, commodities, futures, indices, mutual funds, and options, and cryptocurrencies, and of course, CFDs. Now, CFDs are short-term instruments which allow you to trade commodities, futures, mutual funds, and indices. So while I may say a specific investment product like shares or equities, I'm talking about all of the range of CFDs. But it gets very boring just saying the same word over and over again, so I intermix them. Also tonight, I'm going to jump back and forth between the term investing and trading. Now, typically, an investor takes a longer-term position, while CFD traders take a short-term position. I know the difference, you know the difference, but again, just saying trading gets very boring. So I say either we mix it up with investing or trading, but we're talking about short-term trading because most CFDs are done and closed out by the end of the day, although CFDs can be carried over day after day after day. So they're not forced to close on you immediately. Now, the first thing you have to ask yourself, is CFD trading right for me? Now, CFD trading is ideal for investors who want the opportunity to try and make a better return for their money. However, it contains significant risk to your money and is not suitable for everyone. We strongly suggest trading on a demo account before you try it with your own real money. And if you want, you can go right now to www.ubcfx.com and open a demo account and start practicing CFD trading. Now, CFDs may be ideal for people who are looking for short-term opportunities. CFDs are typically held open for a few days or weeks rather than over long term. Most CFDs are traded to close the same day or within a day or two. They're perfect for people who want to make their own decision on what to invest in. Now, at UBCFX, we provide an execution-only service. That means we don't advise you on any trade to take. We offer you a trading environment in which to execute your trades. Okay, but CFD trading is great for people who want to diversify their portfolio. We offer over 4,500 global markets to trade, including shares, commodities, forex, and indices. If you want to be an active or passive trader, and you can trade as little or as often as you want. Now, the question is, what is a CFD? Okay, CFD stands for Contract for Difference. And they're one of the world's fastest growing trading instruments, and they are regulated. They are an approved trading method or trading asset available and approved by the regulators and monitored by the regulators. So we mentioned earlier, UBCFX is a regulated provider. Now, a contract for difference creates, as its name suggests, a contract between two parties speculating on the movement of an asset price. Okay, so in other words, it's between me, or you in your case, and the broker, because you're not ever buying anything. You're basically signing a contract for an asset, and you're holding that asset for a short period of time. And it's the difference between the price of the asset when you open the trade and when you close the trade. So the term CFD, which stands for Contract for Difference, consists of an agreement to exchange the difference in value of a particular currency, commodity, share, index between the time at which the contract is open and the time at which the contract is closed. Now, in order to open and close a contract, you must buy an asset and sell an asset, but it doesn't matter in which order you do it. Okay, so the difference you get is the difference between the buy and the sell, or the sell and the buy. If you're looking for something to fall, you would sell it earlier and then buy it back at a lower price. If you're looking for something to rise, you would buy it now and sell it at the higher price. Okay, so if you buy first, in order to close your contract, you have to sell. Okay, so if you sell is higher than you buy. It means you own something and you sell it for more than you bought it for, you made profit. If you sold something and bought it back at a cheaper price, you made profit. But when it goes against you, you lose. So your losses and your profit are identical. Okay, they have the same risk in either direction. If you think you can make $100 profit, you can also lose that same $100 because it all depends on which way that contract goes against you. So there's nothing like it's a miracle that you can make tons of money without ever risking any money. But there are ways to minimize your risk with risk management and stop losses. Now, the contract payout will amount to the difference in the price of the asset between the time the contract is open and the time the contract is closed. If the asset rises in price and the buyer receives cash from the seller, and vice versa, if there's no restriction on the entry, there is no restriction on the entry or exit of a CFD. There's no time limit is placed on when the exchange happens, and no restrictions placed on buying first or selling first. CFDs are traded on leverage, and which is one of the most important things. Now, leverage is also controlled by the regulator. So the leverage that you're entitled to, or not entitled to, but that's offered, is based on the regulator and what country you are located in. Okay. So recently, you've seen in all the news headlines around all of Europe that the regulators have reduced leverage a great deal, because leverage used to be up to 500 to 1. So that means you could actually invest or trade 500 times more than the money you had. Okay. They've brought that down only because too many people were taking too big of a risk. So you can still get leverage of 10 to 1 or 50 to 1, depending on the asset you're trading. But that helps you get a bigger market share and larger exposure to the market with a smaller amount of money. Now, to put simply, CFDs let you speculate on the price movement of a whole host of financial markets, such as indices, shares, currencies, commodities, regardless of whether price is rising or falling. Now, this means you don't actually own the underlying asset. You're simply speculating on whether the price will rise or fall. So let me explain that to you. In the world of, say, commodities, if you're buying a commodity, say gold, okay, you're buying gold at $12.50. So if you're going to a gold broker, or you're going to a gold coin store, or you're buying gold, you're buying it at a specific price and you're taking physical delivery. If you're buying it in the futures market, you are buying it for a future price. Now, people don't take delivery because the cost of delivery is extremely high, so they close their contract. But technically, you're taking a future option on a price that you can actually have it delivered. So, say for instance, General Mills, the big cereal manufacturer in the U.S., needs to know that they have wheat coming to their office or their factories every day, and they need 1 million bushels of wheat delivered every day. So they would go in the future, but they can't afford the price, or they don't want the price going up and down, because they're not in the market to trade wheat. They need wheat for their base. So they would go in the futures market and buy the contracts of wheat way out into the future at a low price, but a steady price. Okay, that means that they're going to have a flow of wheat coming in their market into their manufacturing, because they can't change the price of cereal day by day, up and down, depending by the wheat they take. But they don't actually take the physical delivery of that contract of wheat they made with you, and you're in, Zimbabwe. They settle that contract for the cash difference, but it means if wheat went up from $3 to $4, they sell you that contract they had at $4. They made $1 profit, but that means they actually have to physically buy the real wheat, and it's $1 higher than it was. But they netted out at $3, and they were happy. So you become that guy who's just speculating. You're never going to take delivery. You're not owning anything. You're just speculating on the price to go up or down. And you have a contract that says if it goes up, we'll pay you more. If it goes down, we'll pay you less. And that's between you and your broker. So it's like a handshake. Okay. Now, the CFD price is based on the actual price of the asset. I mean, it's not something out in left field that's going all over the place. If gold is $12.50 on the actual market, The CFD for gold is also at 1250. Now, a commodity future is a financial asset that represents an agreement to buy or sell at a set amount of the commodity, like platinum, copper, or oil, at a predetermined price and date. Because the price of commodities fluctuate over time based on supply and demand, a commodity future allows traders to speculate on the price movement of that commodity. If you trade the platinum CFD, you can decide whether you think the platinum futures price will increase or decrease, and then place your trade accordingly. Other commodity CFDs include copper and oil, whether it's WTI or Brent oil. You can also trade stocks, currency, and of course, crypto. Now, I'm going to chop up a short presentation on CFDs. In fact, I have two for you. One's a very simple one because I want you to get your head around what these CFDs are. And I know I've used a lot of words, but sometimes in pictures it's a little bit better to grasp what the philosophy is.
Closely at one of the most popular and innovative investment tools, contracts for difference, mostly called CFDs. CFDs allow you to trade on the price movements of any financial market, like stocks, commodities, indices, or currencies, without actually owning the underlying instrument. If you think the price of an underlying asset will go up, you can buy a CFD and benefit from that rise. This is called going long. If you think the price of an underlying asset will go down, you can sell a CFD and profit from that fall. This is called going short. The profit or loss you make is the difference between the price when you entered your position and the price when you close it. The more the market moves in the anticipated direction, the more profit you make, but a position can also move against you, resulting in a potential loss. When you buy a CFD, you don't have to pay the full value of the position, but only a fraction, otherwise known as the margin. This practice is called trading on margin. By trading on margin, you're able, though not obligated, to purchase more than you normally would. This is known as the leverage effect, and is the main reason why investors like to choose CFDs. For example, let's say stock ABC is trading at $10 US. You think the company's price is about to go up, so you buy 1,000 CFDs. Company ABC has a margin rate of 10%, which means you only have to deposit 10% of the total value of the trade as position margin. So, since 1,000 CFDs at $10 is $10,000 and 10% of 10,000 is 1,000, your position margin is $1,000. Now, let's say your prediction turns out to be correct and stock ABC is trading at $15 US. Your 1,000 CFDs multiplied by 15 now equal $15,000. So you made a profit of $5,000 on your position while only investing $1,000. However, keep in mind, just like you can experience higher percentage returns with a CFD if the underlying stock goes up, you can also experience higher percentage losses if the stock goes down. Here are 4 reasons why you should trade CFDs. First, you can profit in both rising and falling markets. Second, due to the leverage effect, you can use your capital very efficiently. Third, the transaction costs are very low. And fourth, CFDs are flexible instruments that allow 24-hour trading and fast execution. Those are the basics.
Okay, so that gives you a pretty simple explanation of the CFD markets. Now, again, why are they so popular? Okay, first of all, they're leverage products. You can also use them as hedging tools. You can use CFDs to offset any potential loss in value of your physical investment by going short. So you can use them as a strategy for your regular trading or your otherwise investing. Now, the only cost to CFDs are the spread. There's no commissions, there's no other cost, it's the spread. So when you open a CFD position, you can select the amount of the CFDs you would like to trade, and your profit will rise in line with each point the market moves in your favor. So we gave you the example, and you saw the example in the little presentation. So if you think the price of your chosen market will go up, you simply click on buy and your profits will rise in line with the increase in that price. However, if the price falls, then you will make a loss equal to every point you lose. But your trading platform allows you to do what they call stop loss. A stop loss is a price which is the major, the farthest, or the amount you are willing to risk to lose. So say a CFD, say you buy a CFD in gold at 1250. Okay. Well, a contract of gold is 100 ounces of gold. So if gold goes up $1 an ounce, you would have made $100. But if gold goes down $1 an ounce to 1249, you would have lost $100. Now, if you had 5 CFDs, that means you could have made $500 or lost $500. But you can't afford to lose $500. Okay. You don't want to take that risk of losing $500. So you can set a stop loss that tells the platform to automatically close your position if gold falls down to a certain price, and it will automatically close you out so you don't suffer any more of a loss. Now, it gets a little bit more complicated than that because that's a real basic thing, but you also have to take a look at the volatility of gold to make sure, because prices swing up and down all the time, that you're not placing your stop loss too close where you're just going to get stopped out with the swing of the market. So let's give you an example. If you think the price of oil is going to go up, then you could place a buy trade for 5 CFDs at the price of, say, 53.25. If the market rose 30 points to 53.50 and you close out your position, you would make a profit of $150. 30 times the $30 times the 5 contracts you bought. However, if the market moves against you and the price of oil falls 30 points to $53, then you would lose the $150. Now, CFDs do not have an expiry price like options or futures contracts. As opposed to the expiry date, a CFD is effectively renewed at the close of each trading day and rolled forward if desired. And you can keep your position open indefinitely, providing there's enough margin in your account to support the position. In this stance, contracts for difference are very similar to futures without an expiration date. So it means if the market moves against you, you can keep your contract open until it flows in your favor and close it out when it's in your favor. While the contract remains open, your account with the provider will be debited or credited to reflect the interest and dividends if you're trading in stocks. Otherwise, it doesn't make a difference. One of the great features of CFDs is that you're able to trade on both long and short sides of the market. You can choose to long or short a position. If you are long and receive dividends and stock, if you're trading in stock CFDs, if you're short, it does the reverse. So it's worth noting that commission is paid on either side. Commission is not in a CFD market. A spread is paid, a buy price and a sell price, but there's no commissions involved. Now, I've got another little presentation put up for you that's a little bit more professional that hopefully will give you a little bit better explanation of the CFD market and your exposure.
What are CFDs?
The first thing you need to know is that CFDs are complex and risky financial products. It's important that you fully understand how they work before you decide to invest. Unlike share trading, you don't actually own the underlying asset you're trading in. A CFD is a derivative contract between you and a CFD issuer. When you trade CFDs, you're financially exposed to the changes in the value of an underlying asset while the contract remains open. The underlying asset might be a share, a commodity, a foreign exchange pair, or a market index. You can go long, which means you buy a CFD expecting the underlying asset to increase in value, or going short on a CFD means selling it because you expect the underlying asset to decrease in value.
How are CFDs risky?
CFDs are highly leveraged investment products. So let's take a look at an example CFD investment. Say you have $5,000 to invest. If you open a long share CFD position with a value of $100,000, you'll have to pay an initial margin or collateral to the CFD issuer. In this case, a tiny proportion of the exposure, like 5% or $5,000. This leverage can make CFDs seem attractive, but because you're trading with leverage, both gains and losses are magnified, and you can end up losing more than you put in. If the share price drops by 1%, you could face a $1,000 loss. That's 1/5 of your $5,000 investment before even considering fees and charges. Or worse, if an unexpected event results in a 20% fall in the opening share price, this is a $20,000 loss to you. That's your $5,000 investment gone and another $15,000 that you owe the CFD issuer. In some situations, even a stop-loss order may not prevent a loss of this kind.
What's a margin call and an automatic closeout?
If the market turns against your CFD position, you can close out your position and limit your losses, or if you keep your CFD position open, the CFD issuer will ask you to pay extra money quickly. This is known as a margin call. The CFD issuer may but may not close out your contract to prevent further losses. If your margin is not enough to cover your trading losses, you will still be legally obliged to make up the difference.
Are CFDs suitable for me?
You should only consider trading CFDs if you have extensive trading experience. Also, if you're used to trading in volatile market conditions and can afford to lose all of the money you put in and more.
What else should I know?
These are only some of the risks of trading CFDs. It's important that you read a CFD issuer's Product Disclosure Statement, or PDS.
So as you can see, CFDs can be risky, but they can be profitable. Now, again, to give you an example, say you want to sell 5 US S&P 500 CFDs. Forget the word CFDs. You wanted to go into the market and buy the index. Okay, no different than if you went anywhere else to buy the index, the S&P 500, it's got a value, whatever that value is. You want 5 of those, okay, 5 contracts, okay, or 5 CFDs because you're only making one transaction. So if the S&P 500 was trading at 2340, you would get in the market at 2340. Now, if you thought the market was going to go down, you would sell it at the 2340 before you bought it. You'd sell it first at 2340, and you close out your position when it fell, say, to 2275, and your profit would be the difference because you sold it at a higher price than what you bought it. You just sold first and bought later. The opposite is true here, where the market went up, so you would have. So suppose the price of the S&P 500 had risen by 70 points, okay, to 2470. Then it moved against you. So you would have lost equal max. You bought it here at 2340. Same thing here. So you sold it at 2340 first step, but the market moved against you and it rose to 2410. So your loss would be that move. So it mirrors each effect. So once you've chosen your market, you need to know the current price. You can do this by bringing up a trading ticket in the platform. Now, there's many ways you can enter trades when you're trading CFDs. You can go a margin trade, a limit trade. That means a margin trade, a market trade, is executed at the current market value immediately. A limit order means you set the price at which you're willing to open that contract. And it might not be open immediately because the price is not available, but the minute that market hits that price, the system, the platform will automatically execute that trade. And then you have even more involved trades called OCOs. OCOs, one cancels the other. So if you're not sure if it can go up or down, you could say, okay, buy it for me if it reaches this price, or sell it for me if it reaches that price. Whichever one happens first, the system will just do it for you. Computers are a marvelous thing. You can also do good to cancel. Say, for instance, hypothetically, gold is trading at $1,200 and it hit $1,201 the other day. If you're willing to buy gold whenever it hits $1,200, because you know that's a rock bottom price, and you know even if it falls down to $1,190, it's going to go back over $1,200 eventually. You can tell the system that anytime gold hits $1,200, buy it for you, and it can sit out there. It might not be today or tomorrow. It might be next week that gold falls to 1,200 again. But the minute it does, it'll execute that trade for you. Now, CFDs have two prices, which I keep reiterating. The first price quoted and is the sell price or the bid, and the second price is the buy price or the offer. The difference between these two prices is known as the spread. This is your cost of doing business. Okay, the easiest way I can explain to you, most of you got on vacation somewhere and had to exchange currency at a commission store. Okay, when you go in there, there's a price he'll buy the euro from you and a price he'll sell the euro. In the old days, he'd go in and sell it or buy it at the same price, and he'd charge you a commission based on the amount of money you were exchanging. Okay, today he'll buy as much money or as little money as you want at a specific price, or sell you that form of money and he's not making a commission. It's just simply the spread. So when you are trading CFDs, you have to buy one way and sell the other way. So you have to account for that, but that's the only cost. Now, we've been talking about CFDs, and a lot of people get confused. Like if I'm trading a Forex, how many dollars am I betting or euros am I buying? If I'm trading commodity, how many contracts am I getting? If I'm trading stuff. So with CFDs trading, you select the number of CFDs you wish to buy. So a CFD will represent a certain contract size. So with equity trades, one CFD is usually equal to one share. When trading indices, Forex, or commodities, the value of one CFD varies depending on the instrument. You can see which number you are trading by looking at the tick value in the instrument's market information sheet. CFDs are traded in the base currency. So it'll tell you one contract of euro US dollar is 10,000 euros. Okay. Or 1,000 euros. It's going to tell you right on the platform. Okay. Because in the currency market, you don't want to trade 1 euro because a euro moves 4 pips to the right, hundredths of a cent at a time. So a contract of a euro, 1,000 euros is only $1,012. And if it goes up 10 points, that's only 10 cents you make. But with leverage, you can actually get in 10,000 euros for $1,000, hypothetically. I'd have to do the math. But you can then tie up 10,000 euros because that euro moves 10 pips, which is 10 points all the way to the right. You still made $100. So what I was trying to say is CFDs trading is leveraged products, which means you only need to have a small percentage of the overall trade value known as margin in your account in order to open the trade. Generally speaking, the larger the value of your trade, the more margin required. Now, margin is a strange word. It confuses a lot of people. They think it's a cost to fee. It's not. It's simply a deposit. That's all it is. When your trade is closed, your margin goes away. Okay, so if you wanted to buy 1,000 shares of Apple and your margin was $500, if Apple is trading at $30 and it closes at 40, your margin's left in your account. You get the difference of $1,000. Your margin just stays in your account. It's just a deposit required to cover, to get you into that trade. But it's just, think of it as a down payment. That's it. Okay. But it's not a cost or a fee. Now, CFDs are leveraged products. It means you only need to deposit a small percentage of the value. This is called trading on margin. Well, trading on margin allows you to magnify your returns. Your losses are also magnified exactly the same. Now, this means you can gain larger market exposure for a relatively small initial deposit. In other words, your return on investment is significantly larger because most of us can't go in and buy a contract of gold. We can't go into the futures market and buy 100 ounces of gold because at $1,250 an ounce, one contract is 100 ounces. That's $112,000. But with leverage, you might only have to put down $1,000 or $2,000 or $5,000. But whatever, it means that we can get in and trade that contract. So with CFD trading, however, you only need a small amount of the total trade value to open the position. So let's suppose that we give you a 10-to-1 leverage, or 10%. Okay. You only need to put down 10% of the value. So if you were going to tie up $100,000 of an asset, you only need $1,000 to control that value. Now, leverage is now much lower than what we talk about because the regulators, and as I mentioned before, have reduced the leverage that brokers can provide you because too many people are getting involved in too many high-end risky trades. And the regulators want to make sure you know what you're doing and what you're trading. So they've reduced the leverage so you can't go too crazy. Now, the important thing to remember about leverage, however, is that while it magnifies your profits, your losses are also magnified. Now, most CFD instruments are traded on what's called a floating spread, which means that the spreads are affected by the liquidity in the market. The more liquidity, the narrower the spread. So in other words, when you're trading popular assets like the euro, US dollar, and all the liquidity providers are providing it, your spread is much lower. When you're providing exotics where your broker has to go out to small liquidity pools, your spread's going to be higher. Okay. So most of us trade the major assets, the major stocks, the major commodities, and almost all the brokers offer the same spreads. Now, with the new laws that went into effect, you're also protected because your broker must have multiple sources of liquidity and must give you the best execution price possible. So all of that's being monitored. It wasn't the old day where your broker would have one liquidity provider, and whatever that liquidity provider was willing to, to do that trade as what you had to pay. Today, he's got to have multiple liquidity providers send out your traders automatically by computer, sent out to all these liquidity providers, and whoever has the lowest price, and we're only talking pips, thousands of a point, but they must give you and secure for you the lowest entry price in the market. So sometimes you'll actually get in the market for less than you were willing to pay for it, okay, which is a good thing. Now, with CFDs, you can place stops and limit orders. Before you place your trade, it's important to consider your risk management strategy. A key risk management technique is to place an order, such as a stop loss, that will automatically close your trade if the market reaches a certain level against you. A stop loss is an instruction that allows the platform to close your position once it reaches a specific level set by you. This will, as the name suggests, be at a price below the current value or above, depending on where your contract's executed, and is triggered on losing trades to help minimize your losses. Now, a limit order, which I mentioned before, is an instruction to close out a trade at a price that is better than your current market value and is used to lock in profit. So in other words, say you executed the gold at 1250, you could tell the computer way in advance if gold hits 1265, close my position. Because the market's bouncing all around. The second gold hits 1265, it only hits it for a couple seconds, falls back down. The computer still executes it automatically at 1265 for you, and you get out of the market with that $15 profit. So you don't have to be sitting there with your fingers nimbly trying to get out of the market. So standard stop losses and limit orders are free to place and can be placed on the ticket when you're opening your order at the very beginning, and you can also continually change these as the asset's moving in your favor. Having placed your trade and any stops or limits, your profit and loss on your CFD trade will now fluctuate with each move of the market price. You can track these market prices, see your profit and loss update in real time, and add new trades or close existing trades on your computer by using your trading app on your smartphone or your tablet. Okay. But once you are ready to close your trade, you need to do the opposite trade of the opening position. So in other words, if you had bought, you have to sell. But the platforms make it real easy. You just click on close. It knows what to do. By closing a trade, your net open profit and loss will be realized and immediately placed into your account. Now, also, you can trade CFDs you can trade the euro against the dollar, or Bitcoin against the dollar, even though your money is being held in pounds or in euros. Okay. So you're not converting money at any time. You're only securing these contracts. So if CFD allows you to sell and therefore make a profit from falling market prices, it can be used as a tool as investors' insurance to offset losses made in their physical portfolios. So it's another way that you can use hedging. So there's many ways that you can trade or why you would want to trade CFD. So if you're ready, you can go to UBCFX and open a demo account. Do not jump into the markets. Don't risk your money. Trade on a demo account for at least 30 days and understand what you're doing and build your trading strategies. Understand what you're doing, how to trade, try out the assets, understand what they're doing, and then you can start trading because the market's always offering opportunities. So you don't need to jump in there and rush right away. Careful, learn, demo, and then go to real money. So if you're ready, let's get started. Go to UBCFX and open up a demo account. It's fast and free. There's no credit card required. And before you know it, you'll be trading CFDs like a pro. So thank you very much for joining us tonight. We'll talk to you again real soon. And again, thank you for considering UBCFX. Have a good night now.